Welcome to our presentation on understanding your federal benefits presented by Federal Employee Benefits Advocates, an educational company based in Shreveport, Louisiana. All materials distributed by the instructor are licensed for use by Federal Employee Benefits Advocates LLC and are the property of Federal Employee Benefits Advocates LLC. Copyright and other intellectual property laws protect these materials. Reproduction or altering, distributing, copying, or reproducing the materials is prohibited without the express written consent of Federal Employee Benefits Advocates LLC. Reproduction of the materials in whole or in part in any manner without the prior written consent of the copyright holder is a violation of copyright law of the United States. You may not record this presentation in any manner, nor may you reproduce any of the materials in this presentation. This is your disclaimer notice. The information in this program is presented in a generic context. Please accept this information in a general context. The information contained in the presentation is educational in nature and does not constitute any advice in any form or context. The instructor of this program and the organization represented does not endorse or favor any commercial company or product. The federal government does not favor, endorse, or recommend any commercial company, supply, or product, or the views of the instructor or Federal Employee Benefits Advocates, LLC. The first section we'll cover will include the FERS pension benefits. To calculate the FERS retirement benefit, there are two components. The formula is based upon the high 3 average, which is the highest 36 consecutive months, including their base and locality pay. The other component is the length of credible service, which is measured in years and months. Now, the federal agency has the primary responsibility for funding the FERS retirement plan. However, employees must also contribute to the plan as well. All FERS classified federal employees pay 6.2% into Social Security. The amount they contribute into the retirement system is based upon when they were hired. FERS hired prior to 2013 pay 0.8% into the retirement system, so their total is 7% contribution. FERS hired in the calendar year of 2013 pay 3.1% plus the 6.2% for Social Security, giving them 9.3%, and they are categorized as a FERS revised annuitant employee. FERS employees hired after January the 1st, 2014 contribute 4.4% plus the 6.2% for Social Security, giving them 10.6%, and thus classifying them as a FERS further revised annuitant employee known as a FERS FRAE. The FERS retirement system has several different retirement eligibility requirements. The basic criteria in order to be eligible to receive a retirement annuity is a federal employee must have at least 5 years of federal service, and they must be a FERS on the last day of service. Now, the first way a federal employee can retire under the FERS system is what's known as the normal or the immediate retirement with no reduction. This requires that a federal employee reach minimum retirement age, which is somewhere between 55 and 57 with 30 years of service, be age 60 with 20 years of service, or age 62 with at least 5 years of service. The minimum retirement age, or MRA, is the age that a federal employee covered under the Federal Employee Retirement System, FERS, must reach in order to retire with 30 years of service with an unreduced annuity. Now, that wasn't always the case. Under the old system, the Civil Service Retirement System, otherwise known as the CSRS system, an employee had to be age 55 with 30 years of service. When Congress changed the law, for those individuals hired January the 1st, 1984 and beyond, they slowly raised the age from 55 to 57 in order to qualify for the unreduced annuity, and those changes were based upon the date in which the federal employee was born. Another way a FERS can retire from the federal government is through an involuntary discontinued service retirement. The agency is discontinuing the service of the federal employee due to a major reorganization, a reduction in force, or a transfer of function for which the federal employee declined to take the transfer. Now, there is an age and service requirement. The federal employee must be age 50 with 20 years of service or any age with 25 in order to qualify for the involuntary discontinued service. A deferred retirement may be available for a federal employee who does not complete a complete career in federal service. The Office of Personnel Management will look at the high 3 average and the number of years of service when the federal employee separates from service. At age 62, if they have at least 5 years of credible civilian service, they will be eligible for a pension. But because they do not retire on an immediate annuity, they will be ineligible for the Federal Employee Health Insurance, the FEHB, the Federal Employee Group Life Insurance, the FEGLI, and the Dental and Vision Program, known as the FEDVIP. The voluntary discontinued service requirement is available for FERS classified federal employees who want to create what's known as their early out. These individuals did not meet the full retirement qualifications of MRA with 30, 60 with 20 years of service, or age 62 with 5. There is an age and service requirement in order to qualify for this type of retirement. The federal employee must be minimum retirement age between 55 and 57, and they must have 10 years of service, of which 5 must be credible civilian service. There is a reduction of the benefit if someone goes out under this particular provision. There's a reduction of 5% per year, or 5/12ths of 1% for each month under age 62 or age 60 with 20 or more years of service. As an example, if a federal employee had 10 years of service, they were age 57, they would be able to go out, they would get their pension. However, there would be a reduction of 5% per year times the 5 years, giving them a permanent reduction of 25%. A federal employee retiring under the minimum retirement age with 10 years of service under the voluntary early out may want to avoid the 5% early retirement penalty by postponing receiving their annuity. So rather than drawing their annuity immediately, they'll postpone receiving it. Now they must retire with MRA with 10 years of credible service. They can begin to draw their annuity at age 62 or 60 with 20 or more years of service without a penalty, assuming they did not receive a refund of their contributions. The federal employee will be eligible to re-enroll without evidence of insurability when they begin to draw the annuity to enroll in the Federal Employee Health Insurance Benefit, the FEHB, the Federal Employee Group Life Insurance, the FEGLI, assuming they had those two coverages for the immediate 5 preceding years prior to taking the voluntary early out. They'll also be eligible to enroll in the Dental and Vision Program. We've reviewed the various ways you can retire from the federal government. Now let's look at the components necessary to calculate the annuity. The first component is the high 3 average. The high 3 average is the highest 36 consecutive months of service, including the base and locality. Basic pay is the basic salary earned for the position. Locality pay, special salary rates, and within grade pay increases are considered to be part of basic pay and are included. Wage grade employees may also include night differential and environmental pay. Usually for the federal employee, it's the final 3 years of service, but it could be an earlier period if the basic pay was higher during that period of 36 consecutive months. Not all pay that a federal employee receives may be included as part of the calculation for the high 3 average. There are some exclusions: bonuses, overtime pay, military pay, cash awards, holiday pay worked as a holiday, travel pay outside the regular tour of duty are all excluded from the calculation of the high 3 average. The next component necessary to calculate the retirement annuity for a FERS consists of credible service. Credible service can consist primarily of 3 different components: civilian service, military service, and unused sick leave. In order to calculate the FERS retirement annuity, there are 2 different formulas that can be used. The standard formula is used taking 1% times the high 3 average times the years and months of credible service. For those individuals retiring at age 62 with 20 or more years of service, they get an enhanced annuity. That amount is 1.1% times the high 3 average times the years and months of credible service. So the second calculation gives the federal employee covered under FERS an additional 10% by working till age 62 with 20 or more years of service. An example with the FERS 1% annuity calculation: this individual's age 58, the years and months of credible service will be credited at 1%, the high 3 average is $62,000, and the years and months of credible service are 34 years and 6 months. 1% times the 34.5 years times the 62,000 yields $21,390 as the annual annuity. OPM will then divide that by 12 and round down, and that would produce $1,782. Now, at first glance, you may be concerned that that's not a sufficient amount of money in order to maintain your standard of living in retirement. But remember, this is only one of the three pillars that supports your retirement, the other two being Social Security as well as the funds available from the TSP. The FERS 1.1% annuity example uses the following variables. The age is 63. The years and months of credible service would be calculated at 1.1%. The high three average is $62,000, and the years and months of credible service are 39 years and 6 months. 1.1% times the high three average of 62,000 times the 39.5 years yields $26,939 annually. It's then divided by 12, and that gives you $2,244 on a monthly basis. The Special Retirement Supplement is available for FERS classified federal employees who meet certain criteria. Since Social Security retirement benefits are not available until age 62, this is designed to bridge the gap for a FERS who retires prior to age 62. The Special Retirement Supplement, otherwise known as the SRS, is available for a FERS employee who retires on an immediate annuity at minimum retirement age and 30 years of service, or age 60 with 20 or more years of service. If a federal employee does not meet these criteria, they are ineligible to receive the Special Retirement Supplement. The Special Retirement Supplement oftentimes generates questions for federal employees because they may not be familiar with this benefit. Here are some of the more common questions that come up and the answers to those questions. Well, I need to complete any additional forms at retirement. There are no additional forms to complete. You simply complete the SF-3107, the application for an immediate annuity for a FERS classified federal employee. Will I be taxed on this benefit? It is fully taxable because you make no contributions to this benefit. Will I receive any cost of living adjustments for this benefit? There are no cost of living adjustments provided for this particular benefit. What happens if I go out and work in the private sector after I leave service from the federal government? Well, if you go out and work in the private sector and you earn Social Security taxable wages, this year the limit is set at $18,960 for 2021. The Special Retirement Supplement will be reduced by $1 for every $2 you go above this limit. If you do happen to be offered a voluntary early retirement authority, which is a type of retirement benefit, you will be eligible for the Special Retirement Supplement when you reach minimum retirement age. What about the years that you make a deposit or redeposit regarding credible service? Those years for military service or when a deposit or redeposit is made are excluded from the special retirement calculation. The formula for the Special Retirement Supplement is calculated by taking the number of years of service as a FERS rounded to the next whole number. If you end your career with 30 years and 3 months, the number you would use would be 30. If you ended your career with 30 years and 9 months, you'd use 31 years. Divided by 40. Now, 40 is a constant in the denominator, the bottom number, and that number comes from the number of years from age 22 to 62 that are used to calculate Social Security. You would then multiply that times the estimated Social Security benefit at age 62. Now, you can get that from your Social Security statement by going to SSA.gov. SSA.gov will give you the opportunity to get a Special Retirement Supplement example. Looks at the actual years of service is 30. The estimated Social Security benefit at age 62 is $1,200. You take 30, divide it by 40, times the $1,200 of estimated Social Security benefit would provide $900 a month each and every month in addition to your regular retirement annuity until you reach age 62. At age 62, the retirement supplement stops at age 62 regardless of whether you draw Social Security or not. When selecting a retirement date for FERS classified federal employees, it's important to know what the rules are. A FERS can retire on any day of the month, including weekends and holidays. The annuity will begin to accrue the first of the next month. It will be payable on the first of the next month. Most individuals will select the last day of the month to avoid an extended period without a check, and then unused annual leave would be paid out after the retirement. Cost of living adjustments, or COLAs, are designed to help federal employees to be able to deal with the ever-changing cost of goods and services caused by inflation. For FERS employees, they are not eligible for a cost of living adjustment until they reach age 62 in most cases. There are some exceptions. If a FERS classified federal employee goes out on a disability retirement, they would be eligible immediately, or if they had predeceased their spouse and there was a survivor benefit, the survivor would be eligible for the cost of living adjustment immediately. The cost of living adjustment is based upon the change in the consumer price index for urban wage earners and clerical workers. It's determined by using a formula, and the formula is if the CPI is between 0 and 2%, then they would receive the actual CPI increase. If it's between 2 and 3%, they receive 2%, and CPI is over 3%, the CPI increase to the federal employee in the COLA would be the CPI minus 1. Now, a retiree must be retired effective December 1st in order to be eligible, and then they would begin receiving the COLAs in January. The retiree will receive 1/12 of the COLA for each month that's covered by the annuity benefit. This section will cover the FERS survivor benefits. There are several different survivor benefits available to survivors of FERS classified federal employees. If the employee dies while they're employed with at least 18 months of service, they have a spouse to whom they've been married to the employee for at least 9 months or more, a spouse who is the parent of the employee's child regardless of the length of marriage, a former spouse married 9 months or more with a court order, and 2 eligible children. If a federal employee dies while they're in service, the retirement contributions paid into the plan will be distributed in a lump sum amount using what's known as the order of precedence. The first would be the designated beneficiary, a spouse, children in equal shares, parents, the executor administrator of their estate, and then the next of kin. Survivor benefits are based on the length of service. If a federal employee covered under FERS has at least 18 months of service but less than 10 years of service, they would receive, their survivors, the basic employee death benefit, which is equal to 50% of the employee's final salary or high 3 average, whichever is greater, plus a lump sum amount of $34,595.08 for 2021. If they have 10 or more years of service, they're going to receive the basic death benefit we just covered, plus the maximum survivor annuity, which will be equal to 50% of the monthly annuity based on the years of credible service as of the date of death. There is no reduction due to age. In addition, if the federal employee would have been eligible to receive the special retirement supplement, the surviving spouse will be eligible to receive it as well. They will only be eligible until age 60 because that's when Social Security benefits are available for widows or widowers. They will be subject to the earnings test as set forward by Social Security every year. This year it's $18,960. For every $2 they exceed that amount, the special retirement supplement to the surviving spouse would be reduced by $1. An example of a survivor benefit if they have less than 10 years of service. The current salary is $62,579. Their credible service is 7 years and 6 months. The payment to the surviving spouse would be a lump sum payment for 2021 of $34,495.08. 50% of the salary would be $31,289.50, and then their single lump sum payment would be $65,784.58. There would be no pension in this situation. And with no continuing survivor benefit, the spouse would lose access to the FEHB health insurance benefit unless the minor child is eligible for an ongoing minor benefit. They can stay on the health insurance at the TCC rate, which stands for temporary continuous coverage, which is the full cost, which is the employer and the employee cost, plus a 2% administration fee. The FEHB will end after the child is no longer qualified as a minor, which we'll cover in coming slides. The FERS minor benefits for children can be due to an employee's death in service or retirement. There's no reduction in the salary or pension in order to provide this benefit to minor children. The definition of a minor child: unmarried up to age 18, an unmarried child between 18 and 22 if they're a full-time student at an accredited university, and a child of any age who became disabled prior to age 22 and remains disabled. The FERS minor child benefits. With one parent remaining, the child would receive $552 per month up to 3 children. That's the 2021 amount. $16.56 per month divided by the number of children if there's more than 3. If both parents are deceased, they would receive $662 per month up to 3 children, $19.86 per month divided by the number of children if there's more than 3. They do receive the full COLA. However, there is a dollar-for-dollar offset for any Social Security benefits payable to a FERS classified federal employee's minor children. When a federal employee retires, they are permitted to make a survivor election benefit at the time of retirement. There is a reduction in the retirement benefit in order to provide a survivor benefit. They will follow an order of precedence. A former spouse with a court order takes precedence over a current spouse. The election for the former spouse ends if the former spouse dies or remarries prior to age 55, unless the former spouse was married to the annuitant for 30 years or longer. A current spouse, if the marriage to the current spouse ends in death, divorce, or annulment, the survivor election terminates and the annuitant must notify the Office of Personnel Management. They can pop back up to the life-only option. They will not recover any funds that have already been paid into the system. They may also leave it to a person or persons with an insurable interest. This is someone who is related to the employee, closer than a first cousin, domestic partner, same sex, or common law marriage if recognized by the state. An example of survivor benefit cost. The cost and benefits of the survivor annuity for the maximum survivor benefit. The basic annuity, let's assume, is $20,000. The cost to share at the maximum level is 10% of the $20,000 or reduction of $2,000, leaving a net annuity of $18,000 to the federal employee. Upon the death of the federal employee, the survivor annuity would be 50% of the unreduced annuity of $20,000, leaving $10,000 for the surviving spouse. The cost and benefits of the survivor benefit for the partial or reduced benefit. The basic annuity is $20,000. The cost to share is 5% of the $20,000, leaving a reduction of $1,000. The net annuity would be $19,000. The survivor annuity would be 25% of the $20,000 annuity, or $5,000. The insurable interest option on the survivor benefits could include an individual who is closer in a relationship than a first cousin and who has an insurable interest in the annuitant during the annuitant's lifetime. This could include a fiancé, a common law marriage in the states that recognize common law marriage, domestic partners, and same-sex marriages are now recognized. The cost to share depends on the difference in the age between the retiree and the person as the insurable interest, and the retiree must be healthy. If they're older or the same age, there's a 10% reduction, 5 but less than 10, 15, 10 but less than 15, 20, 15 but less than 20, 25, 20 by less than 25 is 30%, 25 less than 30 is 35, and 30 years or more would cause a reduction of 40%. Beneficiary designations are an important part of any estate plan, and the benefits from the federal government are no exception. There are primarily 4 employee benefits to check on. The first involves the FERS retirement annuity. The money that would be paid into the system if the employee died in service would be paid out using the SF 3102 to the survivor who was elected as the beneficiary. The Thrift Savings Plan uses the TSP-3. This form does require a notarized signature. The Federal Employee Group Life Insurance, the SF 2823. A final request for any unpaid compensation after the employee's death, which could include any unpaid annual leave, as well as any unpaid compensation from a remaining paycheck. These forms do require 2 non-beneficiary witnesses as signatures. The TSP form must be filed with the Service Center, and it must include a notarized signature. Copies can be requested to be put in an employee's electronic official personnel file, the EOPF. Best practices would ask you to retain a copy for your records. Outdated or missing designations may cause benefits to be paid to someone other than intended. This section will cover the Thrift Savings Plan. Contributions to the TSP. A contribution can be made by a federal employee using their agency's electronic system or the form TSP-1. These contributions are made automatically on their biweekly payroll through a payroll deduction. The amount to be deducted from the pay will be either expressed as a percentage of the salary or a whole dollar amount. The maximum elective deferral is $19,500 for the calendar year 2021. An amount equal to 1% of the basic pay is contributed by the agency, even if the employee decides not to contribute. It is possible to roll over funds from a similar plan of a previous employer, such as a 401k or a conduit IRA, and these amounts are not subject to the deferral limit. The TSP has a catch-up provision. An employee can begin to make up a catch-up contribution at any time beginning in the year in which an employee turns age 50. The limit is $6,500 for 2021. There is no look-back provision that allows you to contribute amounts missed in previous years when you were eligible. Let's assume you had a federal employee who was age 52, and they would like to go back and make contributions for age 50 and 51. Those would not be permitted. Participants will no longer make separate catch-up elections in their electronic payroll systems beginning in the payroll year 2021. There are 5 different investment options within the TSP and the L funds. The Government Securities Fund is the G fund. The Fixed Income Indexed is the F fund. The Common Stock Index is the C fund. The Small Cap Index is the S fund. The International Index is the I fund. And then there are a plethora of L fund choices beginning with the L Income, the L 2025, the L 2030, the L 2035, the L 2040, the L 2045, the L 2050, the L 2055, the L 2060, and the L 2065. The life cycle funds use professionally determined investment mixes that are tailored to meet investment objectives based on various time horizons. The objective is to strike an optimal balance between the expected risk and return associated with each fund. The L fund strategy is to invest in an appropriate mix of the G, F, C, S, and I funds for a particular time horizon or a target retirement date. The investment mix of each fund becomes more conservative as it reaches its target date. These occur on a quarterly basis. They automatically make the adjustments in the funds to match the particular fund allocation. Life cycle fund features. Each quarter, the L fund's target asset allocations change, moving towards a less risky mix of investments as the target date approaches. The L funds are rebalanced on a daily basis. You wouldn't be able to do that because you're only permitted to make 2 transactions a month unless you're moving money into the G fund. Also, there are no additional charges or expenses within the L funds that affect the investment returns for doing the allocation movements nor the rebalancing. There are several different ways of getting money out of the TSP. While employed, an employee can take a loan. They can apply for a hardship withdrawal, or if they're over age 59 and a half, they can apply for an age-based in-service withdrawal. After retirement, an employee can request a full or partial withdrawal, a series of monthly payments, an annuity to be purchased on their behalf, or a combination of these choices. Federal law requires spousal consent for any withdrawals from the TSP. Your spouse must consent to your full or partial withdrawal if you are a FERS participant. If the balance is over $3,500, a spouse is entitled to a 50% survivor benefit with level payments and no refund feature. A spouse must waive the right to this survivor benefit if a full withdrawal of the account balance is made. Any withdrawal from the TSP will require a notarized signature from the spouse. As previously mentioned, one of the options is to leave your money in the TSP. You are required by federal tax law to take what's called a required minimum distribution. You will receive a required minimum distribution RMD notice after turning age 72. The IRS will require distributions from the account based on life expectancy. The first withdrawal must not occur no later than April 1st following the year in which you turn age 72. TSP will calculate and distribute the RMD. The exception is if you're still working for the federal government at age 72, then 8 months after you leave service, you will begin being required to take your required minimum distribution. There are tax considerations when receiving funds from the TSP. Federal taxes will be owed on any withdrawals paid directly to the participant on amounts that were previously tax deferred. Taxes and penalties may be avoided if transferred or rolled over funds into a qualified account, such as a 401k or an IRA. Withdrawals may be transferred into a Roth, but current taxes may be due. You may also owe a penalty for premature withdrawals if you're under age 59 and a half. However, there is no penalty tax on distributions after you separate from service during or after the year in which you reach age 55 or above. In this section, we'll cover the Federal Employee Group Life Insurance Program, known as FEGLI. The Federal Employee Group Life Insurance Program has several different coverage choices available for federal employees. You have the basic benefit. In some cases, the extra protection benefit may be available for those individuals under age 45. Option A, Option B coverage, and Option C coverage. The FEGLI basic benefit coverage is provided automatically to a federal employee unless they waive that coverage. The amount of coverage is their annual basic salary rounded to the next thousand plus $2,000. If a federal employee made $47,500, they would round it up to 48. They would add the two more to it, and they would be at $50,000 of FEGLI basic coverage. The basic coverage also includes an accidental death and dismemberment. In terms of the cost, the employee pays 2/3 of the total cost. While an active employee, the cost is 15 cents per thousand per pay period. And for retirees, because they receive their annuity on a monthly basis, it's expressed on a monthly basis as 32.5 cents per thousand for the retirees. The premiums are exactly the same. It's just a question of whether it's done biweekly or monthly. Also, postal employees receive their basic coverage for free. The minimum coverage amount is $10,000. The extra protection benefit is available on the basic benefit amount for those employees under age 45. The extra protection benefit is equal to the basic benefit amount. There's no additional charge to the employee. Beginning at age 35, the extra protection benefit begins to reduce down by stair-stepping down 10% per year each year until it disappears at the end of the year in which the employee turns age 45. When a federal employee retires, they'll have to make a choice about their FEGLI basic coverage. There are several choices to choose from. They can choose to waive the coverage, which means when they leave service from the federal government by retiring, the coverage will end. There's a 75% reduction at age 65. They'll pay the premiums until age 65. At age 65, it begins to stair-step down 2% per month until they reach a floor of 25%, and there's no additional cost after age 65. Another choice is they want to keep half of it, a 50% reduction at 65. So they'll pay the basic premium of 32.5 cents plus the surcharge of 71 cents. So the total cost is $1.03.5. At age 65, they stop paying the base premium of 32.5 cents, and it stair steps down 1% per month until 50% remains. But just remember, the amount that they're paying for is based on the original amount they started with, not what it has reduced down to. And then the final choice is they can keep all of it, which means they would pay the base premium plus the surcharge, which is $2.13.5. So all in, they're at $2.45.5. At age 65, the base premium of 32.5 cents would drop off, and they would continue to keep 100% of the coverage as long as they continue to pay the premiums. The FEGLI basic coverage has a living benefit. Only the basic coverage is available for a living benefit. The payment is a lump sum payment to those who have a life expectancy of no more than 9 months. An active employee can choose a full or partial living benefit. Annuitants can only elect a full living benefit. It's equal to the basic life insurance amount plus any extra benefit for persons under age 45 that would be in effect 9 months after the date of the receipt of a completed claim. Payments are reduced by a nominal amount of 4.9% to make up for the lost earnings to the life insurance fund because of the early payment of the benefits. Another type of FEGLI coverage available to federal employees is known as Option A, called standard coverage. To be eligible, the federal employee must be enrolled in the basic. They must have elected this coverage when they came into federal service or during a rare FEGLI open season or providing evidence of insurability that they can qualify for the insurance. The benefits are $10,000 worth of life insurance coverage and $10,000 worth of accidental death and dismemberment coverage. The employee pays the full cost of this insurance, with the cost ranging from 3 to 60 cents per thousand per pay period, and the cost increases every 5 years based on age bands. When a federal employee has Option A coverage when they retire, they'll have to make a decision about what they want to do with the coverage. Their first choice, they can waive the coverage, which means that when they retire, they'll lose the coverage. They can pay the premiums until age 65. At age 65, they can take what's called the automatic 75% reduction. It'll begin reducing down 2% per month until $2,500 remains, with no additional costs being needed to be paid after age 60. Another FEGLI coverage available to federal employees is Option A, known as additional coverage. To be eligible, the federal employee must be enrolled in the basic coverage. They must have elected this coverage when they came into federal service or within 60 days of a qualifying life event that allows an employee to enroll. That would be marriage, death, divorce, adoption, or birth, during a rare open season for FEGLI, or providing evidence of insurability that they can qualify for the insurance. The benefits is the employee's salary rounded to the next thousand in multiples of 1, 2, 3, up to 5 times their salary. Now, the employee pays the full cost of this insurance. There's no subsidy. The cost ranges approximately from 2 cents to $2.64 per thousand per pay period, and the cost increases every 5 years based on the age bands. When a federal employee has Option B coverage at retirement, they'll have to make a decision about what they want to do with that coverage. Their first choice, they can waive the coverage, which means when they retire, they'll lose the coverage after retirement. They can choose to keep the full amount with no reduction. They'll continue to pay the premiums, or they can choose a full reduction, which will allow them to keep the coverage in place until age 65. At age 65, they would pay no additional premiums, and it would begin to reduce down by stair-stepping down 2% per month until zero remains. So there is no floor on Option B coverage. A federal employee can choose to keep some coverage with no reduction and some coverage with full reduction. If they choose the no reduction option, the premiums continue to increase. As an example, from 50 to 54, the cost is 28.2 cents per thousand. When they reach age 55, it jumps up to 0.433 cents per thousand. And then when they reach age 60, it more than doubles at 0.953. So as you can see from this information, the cost of the FEGLI premiums continue to increase exponentially. It is also theoretically possible that over the lifetime of a federal employee, they may actually pay more in an Option B coverage than they would receive in a death benefit. When a federal employee retires with Option C coverage, they'll also have to make a decision about what they want to do with that coverage in retirement. Very similar to the choices that they had available with the Option B coverage, they can choose to waive the coverage, which means the coverage for the family will go away when the federal employee retires. They can choose to keep all of the insurance. They can choose to have a full reduction. There's no cost after 65, and again, it begins to stair step down 2% per month until zero remains. So there is no floor on Option C coverage. Just like the Option B coverage, they can choose to keep some multiples with no reduction and some multiples with full reduction. Federal employees are eligible to keep the FEGLI into retirement if they meet all of the following requirements. They are entitled to retire on an immediate annuity under retirement system for civilian employees. They've been insured for 5 years of service immediately before the start of the date of the annuity, or for full periods of service during which you were eligible if you were insured for less than 5 years, and they're enrolled in FEGLI on the date of retirement. If a federal employee has chosen to do a postponed annuity, they can re-enroll when the annuity begins if the 5-year requirements are met.